So, looking ahead to 2026, what do you consider the main macroeconomic drivers that will determine opportunities and also risks from a multi asset portfolio?
So, after a year of policy induced volatility, we are starting to see a more constructive backdrop as we move into 2026. So, growth has actually been more resilient this year than perhaps expected, but we are expecting to see it slow down, but not necessarily fall into contractionary territory. Meanwhile, we're seeing central banks easing monetary policy rates, and we expect the Fed in particular to continue on that path of easing. And so that backdrop of slow but resilient growth with central bank easing means that it should be a constructive backdrop, we think, for risk assets. So that means we've been favoring both equities and credit in our portfolios. We're seeing earnings revisions improve across the board, but in particular in places like the US and emerging markets, where we think earnings growth will be robust as we move into next year. When we think about the rest of our multi-asset portfolio positioning, we've also been adding to some of our duration or interest rate sensitivity. Again, given the expectation for continued path of easing from central banks, but recognizing that while inflation may be stickier, particularly as we continue to see the effects of tariffs, that rates may settle at a higher than usual rate. And so duration, while it should be diversifying, may not be the silver bullet that it once was. So we think it's important for investors to lean into equities and credit, but to be mindful that we're moving later into the cycle. And so actually taking a balanced approach, and in particular, moving up in quality, both from an equity perspective and from a credit perspective, we think will be important as we move into next year.
So, in the context of US exceptionalism and potential divergences between geographic regions, which market scenarios do you consider most likely for 2026, and how should they guide allocation choices between equities and fixed income?
So I think the question of US exceptionalism has certainly been forefront of investors' mind this year. So whether that's been concerns around tariff-induced slowdown to consumer growth, questions around Fed independence and fiscal sustainability in the US, as well as the continued trend of de-dollarization, we have seen investors question their exposure to US assets across asset classes. We think the case for US exceptionalism is certainly intact, particularly for equities, where we continue to see the trend for superior earnings growth, fueled by continued growth from AI and the technology sector, but also seeing a broadening out as those quality companies with high stable earnings growth and strong balance sheets should be able to continue to perform as we move through the cycle. So we think the US is likely to continue outperforming certainly the rest of the developed world, where earnings growth we think will continue to drive better returns. However, we also like emerging markets going into 2026. They too are seeing an improvement in earnings growth and also have a very prevalent technology sector. They're also seeing some tailwinds, both from the depreciation in the US dollar, but also from some of the fiscal policy changes we're seeing in the region, in particular in China, where they're taking steps to stem some of the deflationary trends they've been experiencing lately, and easing monetary policy, which we think should continue to fuel demand as we move into 2026. So, from an equity perspective, we like both US and emerging markets in particular. From a credit perspective, we find attractive yields in US high yield corporate credit markets. And from a duration perspective, we favor the US given where yields are and expectations for the Fed to continue easing policy. But again, like to look for further diversification across some of the other developed markets like the UK.